Today we're going to go through a presentation on protection with emphasis on living benefits, the importance of having living benefits as well as the dangers of what could happen if living benefits are not in place. First thing that we look at, when we talk to people about protection, you want to talk about 2 points of view: the risk of something happening to someone, and then secondarily the consequence of what happens to them or their family if something happens and they do not have protection in place. Well, the risk is very possible, probable, and prevalent in today's society. People right now, as I'm speaking, having heart attacks, having stroke, having cancer diagnosis. It's not the most upbeat material to talk about, but it is something people need to be aware of. Yes, the chance of a critical illness does grow exponentially as we get older. However, the chance of a critical illness in our 20s, 30s, and 40s still needs to be something that needs to be addressed, because average age of a heart attack, stroke, or cancer is 43. Most people will survive. Previous generations were dying from these events. We lived through them, but many will go bankrupt. The reason is income disruption causes a financial hole that somebody can just not climb out of, at least most Americans cannot climb out of. And that's what leads to this next stat. Over 60% of the bankruptcies, total bankruptcies, due to medical expenses. Of those that were filed, almost 80% had health insurance. So people look at health insurance as a one-stop shop solution. It's definitely not. Yes, there's holes and gaps in that coverage. You still got to pay the mortgage. You still got to put food on the table. So like we talk about, millions of Americans will survive this event, but they can't earn income. They might be able to repair that cash flow and get back to work, but the hole that was created is too big. They cannot climb out of it, and like we talk about, has a cascade effect. Then by the time most of us reach the age of 65, we will have experienced one of these events. So are you covered? Why should your family wait until it's too late? You can be proactive or you can be reactive. Reactive means it's too late. You're screwed. The event's already happened. The reason that it causes financial chaos in the household is because it creates a double-edged sword. You have two opposing forces working against each other at the same time. The income in the household is plummeting. At the same time, the expenses are going through the roof. So if we have access to capital during this particular period of time, standard of living protection, quality of life protection, great. If we don't, if we have access to available credit or debt, or if we have assets that we can prematurely attack, we'll do that. If we have little to no access to either of those, that standard of living that we spent X amount of years building up can unravel very, very, very quickly. At 3 months, you get a notice of default on the mortgage, cure quit notice, basically to bring your account full and paid up, or face possible foreclosure. So you want to make sure that clients are aware. Yes, we all hope for the best, but we have to prepare for the worst. And sometimes if the worst is only a short term, it still has lasting effects financially in the household. People are already stressed out about money. You can see in the survey, 72% of adults said they were stressed out about money last month. Now, if they are trying to fight, recover, if their main area of concentration is supposed to be on their health and they're worried about where their next dollar is coming from, it's a major hindrance on their ability to concentrate on what's important at that time. So at this point, we're talking to people. Make sure we're educating the public. Are you ignoring a major financial risk to your family? Well, you've got two camps of people here. You've got people who have no insurance. If they have no insurance and they have an insurable need, it's kind of like playing Russian roulette. They need to take care of that protection to make sure either them or their loved ones are taken care of on a life or death event. Now, you've also got a great deal of people, tens of millions of people, that have insurance, that went in the open marketplace and did the best they possibly could at that time. But with the new changes in the insurance industry, with the living benefits products, they probably have the wrong kind of life insurance and don't even know it. Part of our education process, we help people identify there's been generational changes in the insurance industry. You know, were you affected? Do you qualify for additional benefits and possibly monthly savings? If somebody already has a financial commitment of X, let's call it $200, and they can get a better product that covers for everything and the living benefits that cover and the death, where their policy just covers for death, it's a suitable replacement. So we've got a reason that we can talk to them. You gain a new client, you gain new premium, and you've done a great deal of good for that client because those living benefits over a normal term, 20, 25, 30-year term, we're mostly still alive, but statistical possibility and probability that we suffer a heart attack, stroke, cancer, disability from an illness or accident is far greater than death. So we want to make sure people understand, yes, it's a death benefit that is typical in the marketplace, but now we can wrap up living benefits as riders into these policies that cover for chronic, terminal, and critical illness. It's very important because recent studies show that nearly half of all Americans suffer from at least one chronic illness. Many of these people have one or more daily activity limitations. 1 in 2 men, 1 in 3 women will develop cancer in their lifetime. So this is a revolutionary new innovative product that can help protect families' plans for today and tomorrow. So once this new insurance is understood, it's easy to see why traditional life insurance would be considered an obsolete product. Once again, yes, it's a death benefit that the client should be used to, but we're also wrapping up terminal, chronic, and critical into one solution. It's not just insurance. It's about a new kind of life insurance you don't have to die to use. Life insurance actually for life. And the last slide on this presentation breaks down the pricing power of one product, all-inclusive, versus building a basket of supplemental products. So you can see over to the far left, 30, 40, 50, and 60. Those are the ages of the individual. These are preferred non-smoker, so good health non-smoking candidates or applicants. So we're going to look at the top, the 30-year-old. So maybe the 30-year-old is having a child, buying a home. Something has spurred them to go out in the open marketplace and look for protection. Well, a typical agent or advisor sells them what they're looking for. In this particular case, it's a $500,000 20-year term for $23 a month. Now what's normally done is the process of building that basket of supplemental products. They go back and they say, you need critical care, you need cancer, you need disability, you need long-term care to have all-inclusive coverage. Well, there's a few problems here. Usually these supplemental products are expensive, they're confusing, they're limited in benefits, and they don't really stick on the books for long periods of time because of one or more variable reasons. So if you add all this up and talk to a 30-year-old about spending almost $350 per month on that basket of supplemental products, conversation's not going to go very well. Even if they do have that kind of money to spend, they don't want to spend it on protection. We understand. We can, we fully understand that. So what we're looking at here is being able to take all of this wrapped up into one product for that 30-year-old at about $1 a day. Now that conversation is going to go a lot better, streamlined down to an application. Most likely the application will get approved, and that 30-year-old has other people in their inner circle that are having the same type of life events. So we've got a great product that we can offer with great pricing power that will get you a lot of referral business. Now, these green numbers underneath, if the 30-year-old did have $349 a month in discretionary or free cash flow, then we can show them, okay, the $320 savings every month, if over the course of this 20-year term you invested that into a fixed 3% account, you have about $141,000 and change at the end of that period of time. Now, if you overfunded for cash value accumulation purposes, our global IUL, the 20-year look-back rate, that would be the estimated illustrated value at that end of period of time. Now, it's a great way to bridge the conversation from protection to asset accumulation using only the savings that you're able to offer them with the one product approach. The 60-year-old at the very bottom of this, it's a different part of the life cycle. Same problem. If you're wrapping all of this up into, or breaking all of this up into supplemental products and building a basket, over $1,500, it's probably more than the mortgage in many parts of the country. Under $300, not going to say that's a slam dunk for the budget, but there's a lot better opportunity and possibility we can help that individual get the protection they need without breaking the budget, so to speak. So this is the term with living benefits. It's a more streamlined, efficient way to get somebody the protection they need, one policy, one debit coming out of a checking account, easier to understand. easier for our clients to absorb that message that we're trying to get across to them, easier for the clients to be able to ask good, informed buying questions based on small presentations. And those buying questions, if answered correctly, will lead to applications.